Hey, it's Scott Wynn here with another no and low down payment home loan video for you. Today I am covering the topic of upfront mortgage insurance premium. My name is Scott Wynn. I'm a mortgage advisor with the Wynn and Egan team at Citywide Home Loans, where we help those that are looking for a no and low down payment home loan program. And that's the topic of today's video, talking about FHA's upfront mortgage insurance premium. See, FHA is actually one of the best no and low down home loan programs out there. Requires just a 3.5% minimum down payment and can be combined with many down payment assistance programs in many cases. If you're looking at purchasing a home in Colorado, we would love to help you in navigating the different down payment assistance programs. And in fact, there are over 66 different loan programs, down payment assistance loan programs in the state of Colorado that we can help you identify which one is best for you. And even if you're looking at purchasing in another state, this video is relevant for you as well. I've even created past video on finding down payment assistance programs where you live, and you can check it out. Now, let's get to today's topic of FHA's upfront mortgage insurance premium. So the first thing is how much is it? Well, it's 1.75% of your base loan amount, and it can be financed into the loan or it can be paid for at the time of closing. In full finance or in full at the time of closing. You can't split it up. So let's just run through a quick example here for you so you can see what it is I'm referring to and how the calculations work. Now, one thing just to be aware of is that 99.9% of the time, the upfront mortgage insurance premium is financed in. Let's just say we're purchasing a home for $300,000, and the minimum down payment on FHA is 3.5%, so that is $10,500. So we take $300,000 minus $10,500, which is $289,500. That's what we refer to as our base loan amount. To get the upfront mortgage insurance premium, we simply multiply that by 1.75%. We get $5,066.25. We'll simply round that down to the $5,066, and we'll add that to the $289,500 base loan amount, which results in a $294,566 full loan amount. So that is what would be financed and used for monthly payment calculations. Now, one thing I do want to point out here real quick is that the full loan amount can exceed the county loan limits in the area that you're purchasing in. So as long as the base loan amount, the purchase price minus the minimum 3.5% down payment, does not exceed the loan limit in the area that you're purchasing, the full loan amount can after you finance in that upfront mortgage insurance premium. So you might be wondering, does it make sense to pay that out of pocket or finance it into the loan? And if you do finance it into the loan, how much does that impact you in terms of a monthly payment? So we're going to go to Google real quick and run a quick calculation just to show you what this looks like. So if you just do a quick Google search for mortgage calculator, what you end up with is this handy little calculator here. And what you do is just plug in, let's say, the $5,066 we would be financing. Let's just use a 3.5% interest rate over a period of 30 years. What this is showing you is that the total payment would be just $23. So really what it comes down to is, do you want to pay $5,066 out of pocket, or would you rather just pay $23 a month? For most people, it's a quick and easy answer, which is I'd rather just pay the $23 a month. That's exactly what I would choose if I were in your shoes looking for a no or low down mortgage program, since I probably don't have an extra $5,000 sitting around that I can apply towards the mortgage. So the other question that generally comes up related to upfront mortgage insurance premium is, do I ever get any of that money back? And the quick and simple answer normally is no. However, there is just one exception. That exception is if you're doing an FHA to FHA refi. So if you've closed previously on an FHA loan, had the upfront mortgage insurance premium, and now you're looking to refi that loan into a new FHA loan, then yes, you can get a portion of that back. Now, there's a sliding scale as to how much of it you get back, depending upon how long you've had the FHA loan. The longest amount of time that you'll be eligible for any sort of refund is just 3 years. If you have had a mortgage for FHA mortgage for longer than 3 years, then at that point, the upfront mortgage insurance premium refund goes to zero. Now, let's just run through a quick example again. Let's just say you're looking at doing an FHA to FHA refi at about 1.5 years into your loan. So that would be year 2, month 6, and on this chart you can see that that would be a 46% refund. So if we look back at the example we ran through a moment ago, and we have the upfront mortgage insurance premium of $5,066, Then we take the $5,066 multiplied by 46%, and we end up at a refund of $2,330%. But there's one big but here. The fact is you're doing another FHA loan, which FHA loans require upfront mortgage insurance premiums, so you would have to pay a new 1.75% upfront mortgage insurance premium on that new FHA refi that you're doing, although you will still get that $2,330 refund that's credited towards the loan at the time of closing. If you have a mortgage or home loan related question that you'd like answered, leave it in the comments below. We'll get that answered for you. Or visit our Facebook page, Instagram page, website, wherever, and get in touch with us, and we'd love to help you out.